Our aim is to bring our best investment capabilities to market in the ETF wrapper, and that, as you said, is across the different brands.
All right, joining me will be Wallace, Global Head of ETFs for Morgan Stanley Investment Management, who's now up to 20 ETFs, nearly $14 billion in assets, including their most recent launch, the Morgan Stanley Bitcoin ETF, ticker MSBT, which that's already at 250 million in assets after just launching in early April. But they have an interesting lineup overall with ETFs branded under Eaton Vance, Calvert, and Parametric, in addition to that Morgan Stanley branded Bitcoin ETF. And so Ali and I are going to have a conversation around how the firm is positioning and approaching the EETF market and how they're thinking about product development moving forward. And we'll also spotlight several of those ETFs, including that spot Bitcoin ETF. Now, to start this week, I'll be joined by Cinthia Murphy, Director of Research at VettaFi. And this should be fun. We are going to look at the top 10 ETF launches over the past 10 years. So the 10 most successful ETFs that have come to market over the past decade. And I will say there are a couple of caveats to this list, which I'll explain for you. But regardless, there are some very noteworthy stories to be found in these 10 ETFs. And I also think several of these ETFs might surprise some people. So we'll go through that list here in a moment. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let's start this week with VettaFi's Cinthia Murphy, who is joining me from Chicago. Cinthia, it is always a pleasure. Welcome back to the podcast.
Hey, Nate. Always excited to be here.
All right. So are you ready to go through this list?
Let's do it. It's a very cool list. So I'm excited about today's conversation.
I am too. Now, I should mention there have actually been a couple of enormous blockbuster launches this year, right? With the ProShares Genius Money Market ETF, ticker IQMM, and the Roundhill Memory ETF, ticker DRAM. But as it turns out, neither of those made the list, at least by our criteria. And let me explain that real quick, because I mentioned there were a couple of caveats. And so to be clear, we are simply looking at the top ETF launches over the past 10 years based on today's assets. And so if you think about this, that distorts the list a little bit, because obviously if an ETF launched in, say, 2017, it's had much more time to gather assets than something like DRAM. And then the other factor, of course, is market performance, because clearly returns play a big role in the total assets in an ETF. And time plays a factor in that as well, right? Because the more time an ETF has to take advantage of good returns, the better. Now, all of that said, let me also say both time and performance are very important aspects to an ETF success in general. So it's not like looking at today's assets is a bad way to do this. I just wanted to mention all of that up front. Anything you would add to that before we get going here?
Yeah, no, Nate, I just think, I went back and looked, the S&P 500 has had 13% roughly annualized gains in the last 10 years. The ag has delivered about 1.7% annualized gains over the last 10 years. So if you compound that, it gives you at least a little bit of a dimension to the impact of performance on some of these funds we're going to be talking about today. But what I love about the list is that it really tells a story about ETFs that solved investor problems at those times. So we have examples of success that came from innovation in cost, innovation in distribution, performance, investment philosophy, and even some perfectly timed product launches for the macro environment at the time. So it's a really cool list.
I agree. It's a really nice cross section. And not to belabor the point, I'll just mention again that longevity is a factor in ETF success. So if an ETF did launch 10 years ago and is still here today and doing really well, that's clearly important. And market performance always plays a big role. If you have an ETF that launches and it's not able to capitalize on the performance of the underlying markets, or maybe the timing's off, again, that's a factor in an ETF success. Okay, so let's go through these. We'll do this in reverse order, starting with number 10 on the list, which is the Spider Gold Mini Shares ETF, ticker GLDM, that has about $31 billion in assets. It launched in 2018. And from my perspective, I think the story here is pretty straightforward in that it undercut its bigger brother, GLD, on fees, right? GLDM is only 10 basis points. GLD is 40 basis points. So I think that's been a big driver. And then I would say gold's performance, particularly over the past year and a half, has played a role here. It's up like 70% if you go back to the beginning of January of 2025. So that's clearly boosted assets as well. Anything else that you would add here?
Yeah, I think GLDM, what was interesting is really a story of segmentation. So State Street was the household name in gold investing. As we know, the first ETF was by them, GLD, the biggest. And, but we were living in the era of, fee compression, lower costs. There were competitors coming up like IAU, other funds that undercut on price. So I thought State Street was really smart here. Instead of cutting fees on their biggest fund, GLD, on the gold space, they just launched the mini me version. We've seen a few mini me's come up over the years. And what's interesting is when you look at asset flows, I went back every year in the last 10 years since this fund launched, and GLDM had positive net inflows every single calendar year. So even when the macro conditions were not conducive to gold investing, even when GLD lost some assets on that all that institutional trading and hedge fund positioning, GLDM picked up assets every year. So it really became this kind of low cost solution, really compelling for long term investors that are looking to maybe dollar cost average into gold every year, despite of what the market's doing. It became a really cool solution, right, sitting right next to its brother, that it's the biggest gold portfolio in the market.
It's still mind-boggling to me that you can get physical gold exposure for 10 basis points. And I know there are some other competitors out there that are very low cost as well, but just in general, still boggles my mind. Okay, so GLDM was number 10. Number 9 on the list is the Capital Group Dividend Value ETF, ticker CGDV, with 35 billion in assets. And two things stand out to me on this ETF. First, I'm guessing some people might be surprised to see Capital Group on this list just to begin with. But if you look, Capital Group is already approaching 150 billion in ETF assets overall, and they've done that in just over 4 years. So they've been a huge ETF success story as a firm. I'm not sure people realize, the scale of that success. And then the other thing is that if you were to pick a Capital Group ETF that would lead their lineup, Cinthia, I'm not sure it would be a dividend value ETF. But here we are. So what do you think about this one?
Yeah, I was a little surprised by this ticker as well, but then when you go back and look at the history of the fund, I think this is one of the big things here is just perfect timing. So Capital Group come into the market and launched the ETF at a 2022, the year when everything crashed, inflation soared, rates went up, and that whole enthusiasm over growth stocks really cooled down. They came out with this dividend value ETF at a time when folks were looking for flight to quality, flight to income, just safety. Not only they did that, but this ETF, a lot of dividend value ETFs tend to be very low growth stocks, things like utilities and, like your classic dividend names. But this portfolio, CGDV, actually tilts towards growth. So it looks for dividend value in companies with high growth potential. So they kind of innovated in the category, and it was just the perfect recipe for success. Well-known brand, well-known manager, well-respected, great reputation, competitive pricing, is very attractively priced, the CTF, and then a dividend value strategy at a time when investors were looking exactly for that. So sometimes you luck out in timing. I don't know if they lucked out or if they just somehow have a crystal ball, but this was perfect.
Well, I would just say again, with that 150 billion in assets overall for Capital Group, I think they've had a pretty flawless entry into the ETF space. Pretty nice execution. So I think that's certainly helped. Okay, number 8 on the list is the iShares U.S. Equity Factor Rotation Active ETF, ticker DYNF, 37 billion in assets. And I think the headline around this ETF is its heavy use in BlackRock's model portfolios. Because if you look, this thing launched in 2019, and it basically had no assets until January of 2024, and then it just went wild. And I think the story is that BlackRock began using it in their models. Would you agree that that's been the biggest driver?
Yeah, and we've seen that phenomenon repeat itself, right, Nate? I mean, we've seen funds that are 20, $30 million funds. They enter BlackRock's model and boom, they're 2 billion, 3 billion pretty much overnight. So, as we know in the ETF business, it's all about distribution. And I think the model portfolio today is kind of the expressway to the distribution muscle. And BlackRock has really shown the market what that looks like. Every time they do a transition in that model, we see ETFs that nobody even knew the ticker become household names. This fund did that. Now, to the fund's defense on its own, it stands on its own. I mean, it uses that 5-factor model to really like be tactical on how it rotates, and really delivered outperformance. So performance is always also a driver of assets, and this fund performs really well. So it's kind of been a really successful ETF from that perspective as well. It's delivered the alpha that folks are looking for, and it comes beautifully packaged in BlackRock's model, which, boy, that just seems to reach just about everybody.
Yeah, and to your point on the ETF standing on its own merits, I think that's a good one and should be emphasized. I just like the model portfolio angle here because look, there's nothing wrong if you can get distribution through model portfolios. That's part of the game, and I'm going to talk a little bit about this with Ali Wallace here later, just in terms of distribution capabilities that Morgan Stanley has. But model portfolios can clearly be a path to success for ETFs, and so if you have the ability to distribute through that channel, there's no reason not to do so. So I think again, that's we were talking earlier, just the cross section of stories and ETFs here. I like this one just as model portfolios as a path to ETF success.
Yeah, I mean it's that distribution story. We've seen a million great ETFs come to market and then they don't survive, not because they're not great ideas, because they don't solve problems, but that distribution is really key, as we know. We've seen it. So model portfolio is a great path to that distribution, to that scale pretty quickly.
Now, the next three ETFs I'm actually going to lump together is, believe it or not, they're all from the same issuer, and that's JP Morgan. So, number 7 is the JP Morgan Ultra Short Income ETF, ticker JPST, that has over 38 billion in assets. Number 6 on the list is the JP Morgan NASDAQ Equity Premium Income ETF, ticker JEPQ, that has about 40 billion in assets. And then number 5 is the JP Morgan Equity Premium Income ETF, JEPI, with nearly 45 billion in assets. And similar to what we were talking about with Capital Group, JP Morgan overall, they really have their ETF business cooking. They're now the 6th largest ETF issuer. And those three ETFs in particular, those are 3 of the 4 largest active ETFs on the market out of nearly 3,000 active ETFs. And so, once again, a lot of success here. I guess, do you want to first comment on JPST and then we can get to the other two?
Yeah, so on the JPST, I mean, JP Morgan came to the ETF market. He had a really strong already reputation, cash management reputation. He brings out JPST when we were sitting in near zero interest rate environment. Folks are looking for a yield. Folks are parking on the short end of the curve. Here comes JPST. So great product, perfect timing, phenomenal firm and brand for the task at hand, which is managing cash in both retail and institutional level. So it's skyrocketed. And what's interesting is even during lows, so like COVID lows, when the interest rates started going up, there's flows have ebbed and flowed in this fund, but it became a very popular go-to. There's others, as we know, Nate, in the short end of the curve. A lot of the as close to money market as you can get ETFs really got popularized in recent years. But JPST just really delivering on the space. Not surprising, really.
And then with the 2 equity premium income ETFs, JEPQ and JEPI, I think we would agree that JP Morgan, they really popularized the options income strategy in an ETF wrapper overall, right? I think we can easily point to them as the reason this category has become so prominent.
Yeah, they found a lot of success in it. Again, they capitalize on periods of really high volatility, which make options premiums super compelling. And they come out with these products. Not only they come out, they work, they deliver. A lot of different products have followed, looking to improve on the original design. But I mean, I'm sure you've seen it too. I mean, I see ads on TV for these products all the time. I mean, it is everywhere. So again, a great solution, a novel solution that delivered at a market time that really was beneficial to this type of strategy using the options overlay. And then, distribution muscle. JP Morgan is everywhere. So just a confluence of factors that could only result in massive success. So it's kind of exciting to see when it all aligns perfectly.
Yeah, and JP Morgan leading the pack with 3 ETFs in the top 10 here. So very noteworthy. Okay, number 4 on the list of the top 10 ETF launches over the past 10 years is actually the largest active ETF, the Dimensional US Core Equity 2 ETF, ticker DFAC. This has nearly $47 billion in assets. Now, this was a mutual fund conversion back in 2021. And so obviously that gave it a nice head start on assets. But you look overall, Dimensional is now right behind JP Morgan on the ETF issuer leaderboard. They're the 7th largest ETF issuer overall. And I actually think there are a lot of similarities in how they're pricing their active ETFs, right? They're doing so very competitively. They're certainly leveraging their distribution channels. So any thoughts on DFAC or Dimensional overall?
Yeah, no, I agree with that. I think in a way, these are firms that had massive following, loyal advisory channels, fiduciaries, institutional presence before they entered the ETF market. So they brought all of that into the ETF space. And in the case of DFAC, it was even a mutual fund conversion. So a lot of those assets already came in from that past, the glorious past of success that Dimension has had with their systematic factor investing approach. So it's not that surprising, and but it's reassuring. It's reassuring to see that these firms were able to bring, in the case of Dimensional, convert the success they had in mutual funds to the ETF wrapper. So it's been exciting to watch.
By the way, not to get off topic here, did you see this news floating around last week that Dimensional might be putting their business up for sale? Did you see this?
Yeah, I mean, I don't know, Nate. I'm when I saw that, I'm skeptical. I mean, the timing seems strange to me. They're not only getting a lot of scale in the ETF business, but they've also been kind of like the operational leader on the ETF share class movement. So I get the impression more that they're leaning in ETFs rather than looking to be sold. So I don't know. I'm kind of skeptical.
I would agree with that, though. Do you remember who had in their 2026 ETF predictions that there would be an uptick in M&A activity in the ETF space?
Yeah, you just want to be right. It doesn't mean this is when it's going to happen.
All right, so we are now down to the top 3 ETFs here. And as I look at this, I would say there's one obvious ETF, there's one surprise, and then I think there's one that will make complete sense when everybody hears it if they don't already know what it is. So the number 3 on the list is the obvious one, and that is the iShares Bitcoin ETF, ticker IBIT, which is also the most recent launch on the list. This came out in January 2024. It's now over $58 billion in assets. That's come down a little bit just with the performance of Bitcoin, but obviously just a massive success. And I'm not sure what else to say about this. I think yours truly has well documented everything with IBIT. So I don't know that we need to spend too much time on this one, but you tell me, Cynthia.
Yeah, no, I mean, Bitcoin is in a category of its own when it comes to asset gathering success, as we well know. It still remains, I think, a heavily performance driven asset gathering success, as we saw in 2025 when Bitcoin went nowhere but down. We didn't see asset flows come in. But just as a quick point, I think what was again here BlackRock doing what BlackRock does well, which is distributing it. So from day one, they put IBIT on their Aladdin platform, which is their platform, their software, risk management software that everybody can use, all the institutions. So pretty much everybody globally that uses BlackRock could immediately incorporate Bitcoin into their portfolios. And that was really smart because you immediately gave reach beyond just listing as an ETF. So I thought that was masterfully done, and that helped a lot here too.
All right. I won't talk about IBIT anymore because, again, I think I've spent plenty of time in the past on that. So let's get to number two on the list. And this is the one that I do think will surprise some people. And maybe it's just me, but I just feel like it's such a boring ETF. And that's the iShares 0 to 3 month Treasury Bond ETF, ticker SGOV, SGOV. This launched in 2020. It's now over $91 billion in assets. And so I'm curious to hear from you. Why do you think this has had so much success? Because there were obviously other short-term treasury ETFs on the market. I would say most notably BIL, the Spider 1 to 3 month T-bill ETF. That launched in 2007. So it'd been around for a while. Do you think maybe it just came down to the lower fee on SGOV, or is there more to the story here?
Yeah, I mean, SGov is about 35% cheaper than Bill. So if you're paying to park cash as close to cash as you can, paying 35% less, maybe the real story here. It may be significant enough, I mean, to drive all these flows. I've seen folks argue the 0 to 3 month versus 1 to 3 month portfolio exposure also matters in just how much incremental yield you get. I mean, people have gone nuts over the years trying to figure out what's the real nuance here because these portfolios are practically identical. So I think the lower cost has to, in my mind, is the cleanest explanation on why this fund has done so well.
I would love to have been sitting like in the iShares brainstorming room prior to launching this back in 2020 and wondering if they thought this would get to nearly $100 billion in assets in 6 years or so. Again, just a massive success for something that looks very plain vanilla, but credit to them. And again, that I think you're right. Clearly, the low cost has played a factor here. Okay, number one on the list of the top 10 ETF launches over the past 10 years. I feel like we need a drum roll or something. Maybe we can have production add that for us. It's the Invesco NASDAQ 100 ETF, ticker QQQM. That has over $97 billion in assets. Of course, like we talked about with GLDM and GLD, this ETF undercut its bigger brother, QQQ, on fees. So it's at 15 basis points versus 18 for the triple Qs. But putting that aside, I just think performance has been such a big part of the story here, really for both of those ETFs, because you look at the NASDAQ 100, it's up over 160% since QQQM launched. It's outperformed the S&P 500 by 25-30% over that time. So I think clearly everything that we've seen going on with the AI boom and technology, this has been a place that investors have gravitated. So this is the one I said, I think when people hear that this is number one on the list, it makes perfect sense, but maybe you don't immediately think of this as the top ETF launch over the past 10 years. What do you say on this one?
Yeah, I agree from the perspective that it's another one of the mini me funds. So lower cost, lower share price, so easier to get exposure to if you are a retail investor starting out, as opposed to pay for a share price of QQQ. But I mean, the ETF for the times we live in, I mean, folks look to the Qs as the tech proxy for everything that's cool happening in the tech world. Whether that's accurate or not doesn't matter. That's how folks look at that fund and how they implement it. And then here comes QQQM, that is much cheaper, lower share price, easy to dollar cost average. And boom, you have the number one most successful asset gatherer in the last 10 years. So it's sometimes solving an investor problem and innovating isn't that hard, or at least they make it look like it's not that hard.
Well, and I think this is going to be an interesting story to watch moving forward for what is probably an obvious reason to most people. NASDAQ is fast tracking these mega IPOs. So we're going to see SpaceX included in this index pretty quickly after it debuts. We'll see likely OpenAI and Anthropic. And so this is not an investment commentary, but if you just think about interest around the Qs or the Nasdaq 100, I think there's still going to be a lot of interest there if you want to have exposure to those stocks. The other part of this equation is it looks like there's going to be some competition entering the space fairly soon because iShares and State Street, they both filed to offer Nasdaq 100 ETFs. And so I don't know. Do you think that could be problematic for QQQM? It's like on one hand, you're going to have all this interest with these mega IPOs. On the other hand, you're going to have these competitors coming into the space. Any quick thoughts on that?
I mean, if we think about SGov and Bill that we just talked about, it was nobody could see disrupting Bill the way SGov has, but that was with a 35% cheaper fee. I can't imagine that competitors can really undercut QQQM here that significantly. So I think it's anecdotally interesting, and the model conversation may really put something like accused from BlackRock on the map in a way that we don't anticipate without question. But is that going to disrupt QQQM? I'm not sure. It's that fund is seems pretty sticky.
Yeah, well, I can't wait to see how that plays out. Next time we should do something like you and I have to go pick ETFs that we think will be on the top 10 list, 10 years from now or whatever. That might be fun. Find some under the radar ETFs. But Cinthia, we'll have to leave it there. Always enjoy visiting. Thank you so much for joining me this week.
My pleasure was mine, Nate. Thank you.
That was Cinthia Murphy, Director of Research at VettaFi.
Navigating the ETF market? Get the precise data and analytics that smart investors rely on. Build a stronger portfolio today at etfdb.com.
I'm now joined by Ali Wallace, Global Head of ETFs for Morgan Stanley Investment Management, who currently offers 20 ETFs, nearly $14 billion in assets. That's across several different brands. So they have a Morgan Stanley branded Bitcoin ETF, and they also offer ETFs branded under Eaton Vance, Calvert, and Parametric. It's a unique lineup overall, as we'll get into. Ali is now joining me from New York. Ali, it is so great to connect. Welcome to the podcast.
Been a long time fan, so I'm very excited to be here.
Well, I'm very excited to have you. And, I thought we should start with at least some quick background before we get into the ETF lineup, because I know you came over to Morgan Stanley in early 2022 to obviously spearhead the continued build out of the Morgan Stanley ETF platform. But you are not new to ETFs, because prior to coming over, I know you spent 13 years at BlackRock. You helped expand the iShares ETF lineup. And so to start, maybe tell us a little bit about that experience and then how you ultimately ended up in your current perch at Morgan Stanley.
No, oh yes, thank you. So as you mentioned, I was at BlackRock for 13 years previous to joining Morgan Stanley in this launch of their ETF platform. And so previous to that, I was actually on the sell side. So I worked in fixed income and equity sales trading. And right before I joined BlackRock was covering BGI from Morgan Stanley's equity sales trading desk. And so knew I kind of wanted to make a change and go more towards the asset management buy side. And who I was covering at the time said, well, we have this growing ETF business, iShares, did not know anything about it. He didn't even know really much about it, but thought it sounded quite interesting. So I ended up joining right during the financial crisis, right before actually BlackRock came and bought BGI, and obviously the rest is history there, but was, very new to ETFs in the beginning, but really found, I guess I'd say, a purpose in them. I really believe in the product, and it felt like just such a good match with my previous experience, both in equity and fixed income trading. And so was there for 13 years and did, global capital markets roles as well as global product roles. My last 3 years really focused on going within the broader firm and looking at what products wanted to wrap in ETFs from an active point of view. And then that led me obviously to Morgan Stanley to the current day. I really felt Morgan Stanley had so much potential, so much to bring to the table, and wanted to join the team and be a part of that effort.
So, in terms of what Morgan Stanley can bring to the table on the ETF side, and we'll obviously get into some specific ETFs, but I'd love to have you talk a little bit more about the current positioning of the lineup. So, I mentioned those several different brands, such as Calvert and Eaton Vance. Just at a very high level, Ali, how is Morgan Stanley attempting to position within the ETF space?
Our aim is to bring our best investment capabilities to market in the ETF wrapper. And that, as you said, is across the different brands. And so it's a more complex story with the brands, but felt very strongly, especially from a sales point of view, that these brands really represented the underlying investment capabilities. And it takes so much effort to build that brand recognition over the years. If you look at these brands, they have 40 plus years of doing what they do best. And so the Calvert obviously being more of the social governance, Eaton Vance, that fundamental active, and parametric, more of that systematic. And then the Morgan Stanley, obviously a more of a broad firm capability. So the platform is really represented by that culmination of different brands and those investment capabilities, and all under the one MSIM ETF umbrella.
I'm really curious. How do you think about that from a marketing perspective? That sort of complexity with the various brands, because I think to your point, I would say all of those brands are very prominent. Everybody knows those brands in the investment world, but does that then pose a challenge if, let's say, you're trying to lead with Morgan Stanley Investment Management? Like, I'm just trying to think about how investors and advisors might how might they view your lineup and ultimately find your offerings.
Yes, and I mean, as you said, it is not an easy challenge that we took on. It has been a journey over, all these brands became part of Morgan Stanley, part of the Eaton Vance acquisition in 2020, and so our sales force was very familiar with selling these individual brands. So we didn't want to really mess with that good mojo that was going on there, and so wanted to have this compilation of brands, but in that selling the brands individually is very different than having a platform that you're also trying to sell a platform. And so that has been an ongoing effort with our marketing team. So we're moving more towards having Morgan Stanley actually in the brand as well. So somewhat of a co-branding in the sub-branding. I think you see that often. I think even Innovator sent out an email recently and had Innovator by Goldman, or some of that language that is very prominent in the marketing world. But that is how that we're tying the platform together. Long term, it might all be under the Morgan Stanley brand, but as of right now, we feel the most, I'd say, strength that we get from a sales perspective and from a brand recognition perspective is with those sub brands. And an additional layer of complexity on that is obviously Morgan Stanley has a very prominent wealth business. It is more challenging for us to get our product on competitor platforms and be able to market with that Morgan Stanley brand. So these sub brands also give us an inroad to be able to talk to some of our competitors a little bit more seamlessly if it was rather than just listing a Morgan Stanley fund on their platform.
That latter point, that's a very important point, and I think one that people who follow the ETF space very closely will certainly appreciate. And that actually gets into something that I wanted to discuss with you, which is distribution. And I would say, Ali, something certainly unique to Morgan Stanley is the fact that I would say you have distribution in spades. And I always say distribution is king in the ETF space. There are only a few other firms out there that have similar distribution capabilities to Morgan Stanley, but it's not many. And so you do have this army of wealth managers. You have robust model portfolio capabilities, all of those sorts of things. I'm curious, how does that play into how the firm thinks about product development on the ETF side?
Yeah, I mean, I think you saw that come through with the Bitcoin ETF. That was very much of a one firm joint effort. I'd say when I first joined, you know, being that wealth is an open architecture platform, and there's no favoritism per se to the working in house. The conversations were actually a lot of times a little bit more challenging to even get our product on versus competitor. And you've seen that actually come together a little bit more in the last 3 years. And this Morgan Stanley Bitcoin ETF was probably the best example that we've had. It was very much our advisors, there was a need in the market. They see the opportunity. Obviously, there's a lot of other choice out there with Fidelities and iShares, but really could see that as a firm, there was a lot for us to gain if we had our own product and be able to offer that within our broader distribution, long term, be able to include it in models per se or whatever that may hold, but really felt that that was going to be a one Morgan Stanley effort. So I'd have to say that is more of a new dawn for us of how we're trying to work across the firm to ensure that we're bringing products to market that actually meet the demand from our wealth side, as well as we have our own 100+ salespeople within the investment management arm that just go out and sell our own product. So trying to build product that meet both of the demand on those client platforms.
The Morgan Stanley Bitcoin ETF, that is such a perfect example of how you looked at the distribution capabilities and brought a product to market that you could take advantage of those distribution capabilities. And I guess let's talk a little bit more about that ETF itself. It just launched in early April. Already it's at about 250 million. Obviously, there's some fluctuation there depending upon the underlying performance of Bitcoin. You talked about the importance of that distribution, but I look at this ETF. It's the lowest cost spot Bitcoin ETF on the market at 14 basis points. I'm curious, how did you think about all of this from a competitive standpoint? Because obviously there were some competing products that came to market over 2 years ago. And so you're coming in, after a lot of these other products had a fairly substantial head start, but here you are, already some very early success. And again, lowest cost spot Bitcoin ETF on the market. Just take us behind the scenes a little bit in terms of how you were thinking about all that.
With eyes wide open, that we knew that we weren't going into a market that already didn't have, competitor product into it. So in that, knew that we had to differentiate ourselves in some ways. Price obviously was one thing. We did try to also differentiate based off of our digital asset custodians. So we do use a GSIB as well as a more traditional digital currency custodian. So that co-custody model is somewhat unique in our product. But when it came to actually the expense ratio and everything that we were thinking about there, we knew that in order to get clients' attention and in order to have a seat at the table, we had to come in quite competitive. So in that, being a larger firm, we were able to, from a scales perspective, be able to actually come in at that lower price. And I think we've been quite pleased with the reception to it. The initial uptake was really direct investors that through our E-Trade platform and through other online platforms from an investment standpoint. So it wasn't necessarily through the Morgan Stanley Wealth, which, I think probably everyone thinks that initially, but it does take time for us to get approved on there. So going forward, that obviously will be a big push within that, platform. And we are working across all the other mediary platforms, independents, in order to get the fund onboarded as well.
I know it's still very early, but how are you seeing this ETF being used thus far? Like, are there any noticeable trends you've observed in terms of who's using it, how they're using it, those sorts of things?
Yeah, I mean, as you said, from a direct investor, I think from the low expense ratio, that has been attractive just to them, if they're going, I have sold off during some of this drawdown recently from the Bitcoin and are going back in to add exposure. I do think that we've gotten some allocation based off of our expense ratio and being, Morgan Stanley. We were able to get some really good buzz on X, which is, new for Morgan Stanley. We're not really an X Twitter. So that was quite exciting for us. But I'd say more recently, we are working with different advisor teams, whether it be, more in Miami area, Southern America, on how to be able to in-kind some of the Bitcoin into the fund. So that has been a big focus for us. We have a long, I'd say, laundry list of people that we're working with. Not a lot has come to fruition as of yet because all have different, I'd say, indicators of when they want to pull the trigger based off of Bitcoin and where it's trading. But that is probably where we see like the most unique focus of, really traditional clients holding it still on chain, really would like to diversify and hold some in the ETF structure for all the reasons that you've probably talked about on here when it comes to, being able to hold it more traditional, wealth planning, margin, being able to use it for all of those trading capabilities. So those are some of the more unique conversations. We did have a decent sized trade into the fund about 2 weeks ago that was using more of an in-kind from a client and back into an ETF. So more to come on that, but that's some of the initial uptake in it.
I think that's so interesting because we were talking just about Morgan Stanley's distribution capabilities, but putting that aside, you think about all the capabilities Morgan Stanley offers on the wealth management side and estate planning and all of those sorts of things. So if you have an investor who, let's say hypothetically, they were early to Bitcoin and they hold Bitcoin direct, maybe they do want to in-kind that, own the ETF, get on the platform, on the Morgan Stanley platform, and then have access to all of these other opportunities or services, shall we say. So that makes a lot of sense. And again, I think from a competitive positioning standpoint, very interesting. So we'll have to watch that.
They're already, for the most part, on the Morgan Stanley platform. So having to hold that separate and you spoke to Amy recently and everything that Wealth is doing to allow for that, direct digital custodian to be able to hold that on the Wealth platform. But as of right now, it is separate. So if a client holds, their digital assets, it is not associated with the overall view that they see on the Morgan Stanley Wealth platform. So this is a big, I'd say, benefit to them if they can have some of that exposure so they can see their full picture of, their asset allocation.
All right, if we move beyond MSBT, because I could keep talking about that for another hour or so, there have been several other fairly recent additions to your ETF lineup. So I was looking, there's the Eaton Vance Preferred Securities and Income ETF, ticker EVPF, that launched back in March. There's the Eaton Vance Income Opportunities ETF, ticker XAG, that launched last November. And then if I go back to last August, so still within a year, there's the Eaton Vance Mortgage Opportunities ETF, ticker EVMO. And so, just high level, all actively managed products, all income oriented products. What was the thought process behind bringing these to market?
Yeah, I mean, I think I was just actually talking to someone on this when it comes to fixed income and active management. I lived in the passive world for so long and was such a passive I'd say disciple and still, obviously see the benefit there. But coming from into this where we do have such strong fixed income capabilities and the ability to see what that does from an alpha generating point of view, what that brings to the client. It's really been eye-opening to me and really feel that we have one of the top fixed income offerings across the street when it comes to performance. So really wanting to take advantage of our strength in the fixed income. So our teams are all, basically run boutique oriented, have their own investment process and really ensure that that is independent of each other. And so when you look at the three funds that we launched, we really want to ensure that we're covering across all the sectors. So whether that be mortgages, as you mentioned, XAG is really in order to generate from a high income. So really goes outside of that traditional investment corporate bonds and looks into high yield loans, securitized. So really goes into some of the non-traditional, what you would see from a core bond perspective, and then well as EVPF. From it, we've really had some strong performance out of the gates in that, and that is another area where really pairing with our fixed income broad markets team that generates a lot of the research, a lot of that macro views, and that is paired with parametrics. So we're bringing together two teams in that fund. to bring the power of what they can bring in from a performance standpoint. There's really so many different iterations that we're trying to bring together across the platform, but fixed income is probably our biggest theme, and the strength that we see from a performance standpoint really stands out to clients in that aspect.
To your comment on sort of active versus passive, I believe all of Morgan Stanley's ETFs are active, with the exception of a few Calvert ETFs. You can correct me if I'm wrong. Well, so like, how are you thinking about that overall? You mentioned these capabilities that Morgan Stanley has. Obviously, you're going to lean into those if you have these capabilities on the active side. Do you still see a path where it's both moving forward, or you think it's really leaning into those active capabilities?
For the most part, I think we're really focused on the active. I mean, and you see obviously all our competitors coming to market, not a lot to be able to bring from a passive point of view. I mean, we have done the homework, and if it does make sense, whether that be pairing with, our wealth, and can we make something that adds to the ecosystem from a product standpoint by adding another passive, and as of right now, we just don't see that. We did see that opportunity. We felt still in the crypto space because it still is fairly new compared to obviously some of those products that have been out there for so many years. So for the most part, it will be very active focus. Those Calvert funds that we initially launched, those are IP of Calvert and the uniqueness of what they bring in their Calvert process. So felt that was unique enough to be able to bring those to market in that passive format. But otherwise, everything from the parametric and advanced products, as well as probably any additional Calvert that we launch, will all be active tilted.
We have a few minutes left here. Are there any other ETFs that you would highlight? I know the Advanced Total Return Bond ETF, ticker EVTR. That's currently your most popular ETF in the lineup, well over $5 billion in assets. But again, you have a wide range of products. Any other ETFs you'd like to comment on?
Yeah, I'd say like we are really just as a platform, our sweet spot, which has not been, I'd say, the case for everyone, has been conversions. So if you look at EVTR, XAG, EVMO, some of these products that have had track records back to the 80s, 90s, we saw an opportunity to be able to convert those and have been able to really grow assets since the conversion, which I feel is somewhat of a differentiator. Our sales team very strong in knowing those strategies once converted. And so if you look at EVTR, which is our advanced total return fund, so it's a 5-star in that core bond plus category. It has, when we converted it, was around 350 million, and now it's at 5.3 billion. So it's one of the, I'd say, probably more successful conversions that has happened in the market. And that is where you will continue to see more of that from us. We're not going to convert anything that does not have a good track record, that we don't think sales can sell, but we have a lot of hidden gems that, not being in the preferred ETF wrapper, and if we can revamp them when it comes to, what we charge, having them in the ETF wrapper, we really feel that there is a long-term value proposition for them being an ETF on our platform.
Before I let you go, what else might we see from Morgan Stanley moving forward? So you just mentioned conversions. We talked about leaning into active. I know there are some crypto filings still out there. No, you can't comment on those because those are live filings. But as you think about expanding the ETF platform, and obviously you're not going to give us your full playbook here, but just talk a little bit more about how you are approaching product development moving forward, like where you see opportunity.
I'd say like our two areas of strength that we see opportunity is really looking from a One Morgan Stanley approach, kind of similar to this Bitcoin, as I mentioned, is how as a firm can we also deliver product on the platform, whether that be, using our research partners, partnering with wealth on a client need there. Will be a big proponent of what product we launch, as well as rounding up our lineup for our current investment capabilities. So as of right now, we do have a very, as I mentioned, robust fixed income offering. The equities are not as robust, and that's more just to ensure that we can bring product to market that makes sense with each other. As I mentioned, the firm has been more boutique oriented, and each team has kind of run their own strategies. So trying to bring a platform that can actually tell the story of how these equity funds complement each other. But that is a big focus as well in the next year or so is what can we bring from an equity side, whether that be parametric, continue with the parametric product and what they bring from a premium income, a hedged equity, or more of that fundamental active from an Eaton Vance perspective.
Well, I'm certainly highly interested to watch as you continue to build out the ETF platform. Such a pleasure to connect, Ali. I really enjoyed the conversation. Thank you for joining me.
Thank you so much. I really enjoyed it.
That was Ali Wallace, Global Head of ETFs for Morgan Stanley Investment Management. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I'll be joined by Sylvia Jablonski, Chief Investment Officer at Defiance ETFs, whose quantum computing ETF is absolutely on fire this year. It's now close to $6 billion in assets. So we'll certainly discuss that along with several other Defiance ETFs. And then I'll also be joined by Wayne Pinello, founder and CEO of NextGen EMP. So we'll be spotlighting their Efficient Market Portfolio Plus ETF. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.